Episode 3, Episode 4, Your Wealth Playbook. Welcome back. Last one was structures. This one as well that we work with a lot of clients, Jared, is going to be talking through self-managed super funds. A little bit of around the grounds though, something that I've been working with or doing myself personally is, a little bit of Stoic philosophy. And something that hit me really hard this week was we suffer more in imagination than we do in reality. So in terms of putting that into perspective, what we talk through our own mental capacity and what we talk to ourselves about, we often suffer more than what reality is if we can just get over ourselves and get out there and do it. I think that we find out that it's actually not that bad. So little framework, especially when we're looking to build wealth, it can be quite a big step initially getting started. It's important to obviously have a team and a plan around you, but it's not as daunting as a lot of people make it out to be, and I always want to rely on myself and not rely on anybody else, so therefore making the time to make sure I get educated and away I'll go, which is hopefully what we can do here. A question that I get asked all the time is around, can I buy property inside a self-managed super fund? Yes, but if someone's just clicked onto this and are wanting to know what they're going to get out of the next 20-25 minutes, Jared, if you could summarise the benefits they'll get out of listening to this podcast, 30 seconds or less, what would that be?
30 seconds or less. Well, I'm really looking forward to my Stoic philosophy books coming in. They're due in today, so I'll be able to talk from the heart about this next week. What is SMSF borrowing and why do people do it? So everybody that works gets money put in their super fund every single week, fortnight, month, by the quarter, potentially, by their employer. If they feel that they have the ability to buy an asset, a property that's residential, commercial, do some share trading, even potentially dabble in crypto and do their own thing better than what their fund can do, have more control because of certain reasons, they've got the ability to put that into a self-managed super fund and go out and do it themselves. The why behind it, obviously we can see that residential property has been a great asset class for people to put money in. Commercial property and the returns they get have also been a great area. People have expertise and think that they can buy properties that are in areas that are potentially undervalued and go up quicker than what their current fund will. And also business owners. So if you've got a property that you feel that you can trade out of, you want to pop it in an SMSF and let your business pay rent, which essentially then becomes a super contribution. There's some pretty good reasons to put a property into an SMSF or to run an SMSF yourself and use those funds that you think you can do a better job.
Yeah, perfect. Absolutely. A couple of things with a self-managed super fund is obviously the control. You've got control over what asset class you have and how that money is invested rather than just your traditional industry or retail funds. However, there are some pretty strict rules around self-managed super funds that you need to adhere to, be aware of, making sure that you don't end up in non-compliance land for a self-managed super fund, because in essence, the self-managed super fund gets taxed at a super low tax rate of 15 cents in the dollar for all of the income above the expenses. If it's non-compliant though, it gets taxed at 47 cents in the dollar. Not a place that you want to be for your long-term retirement savings. It does work well for business owners, people with specialties, people that if you think that you can do better than what an industry fund can do. There's some costs associated with setting up a self-managed super fund. We work with a wide range of clients, and I work with a wide range of clients who do have self-managed super funds and how they're really beneficial. Sometimes they're great for particularly business owners, especially if you're renting a commercial property and you are paying lease to somebody else. It's, as the old saying goes, I would rather be paying off my property rather than somebody else's. It's something that we talk through, and it can be beneficial because generally if you're a business owner, you already have your family home and you don't want to hamstring yourself with your borrowing capacity by then trying to purchase a commercial shed, but you can't do that because all your money's tied up in your $1 million family home that you've got. And that you may also not have the deposit for a self-managed super fund. As you mentioned, there's going to be contributions going in each week, month, fortnight, quarter. It used to be quarter. 1 July 2025, though, new rules change and superannuation contributions have to be paid at the time that you get paid. So they could have been put in every quarter, but if you now get paid fortnightly, your employer now has to put in contributions every fortnight.
These little nuggets of gold coming out here.
Little nuggets of gold, yes. So that's continual income into your superannuation platform rather than just a lump sum every quarter, which the government have gone through and done feasibility studies on. And if you dollar cost average in, the more often that you do it, especially through a super fund, the higher your balance is going to grow naturally. So that you're not timing the market every quarter whenever that gets paid. So Couple of key things there. Obviously, works really well, self-managed super funds for business owners. You've got a deposit there. It works really well for someone who's got specialty inside property. Can work really well if you've got some alternate investments that you want to have and hold that you can't hold through an industry fund or a retail fund. But self-managed super funds aren't for everybody. And they do come with additional accounting fees, audit fees, asset fees that you have to go through each and every year. And as I mentioned, there's some pretty specific rules around the Superannuation Industry Supervision Act 1997 and also 2001 that you have to be across, because if you are the member of that self-managed super fund, you also have to be director of that. So you take into account your retirement savings, and there's some rules that you need to adhere to.
Lovely.
Yes.
Now, what's a limited recourse borrowing arrangement?
Oh, jumping right into the details. A limited recourse borrowing arrangement is if you go and purchase a property inside the self-managed super fund and there's going to be debt associated with it. You can't just hold that debt inside the self-managed super fund. One of the rules is that it has to be in another entity, so to speak. It's called a limited recourse borrowing arrangement. All that establishment is it just allows the self-managed super fund to go and borrow money to go and purchase property. You can do it. It's quite a nice way to do it. And the limited recourse borrowing arrangement, in essence, all it is that exactly what it says, a limited recourse borrowing arrangement. So if you have a commercial property or a residential property and there's lending on it, and if you were ever to fall away and you couldn't meet your obligations to pay for the lending, then all that the lender can then take is the property. It can't take any other assets inside or associated with the self-managed super fund. So it's basically like a quarantined where only the property is accessible. So therefore, inside a self-managed super fund, generally has to have a higher deposit to be able to purchase it. So generally around 30%. So if you've got $1 million property that you want to purchase, you'll have to have a 30% deposit for it, plus cost, because the risk is back onto the lender. So therefore they mitigate that risk by making sure that there's a larger upfront deposit because of the limited recourse borrowing arrangement. They can't get any other assets inside the self-managed super fund. So it gets put in place also there to protect you that if anything happened inside that property, that they can't take all of your retirement savings.
So when our friends at the bank look at this, they say there's a little bit higher risk. They obviously don't have the ability to leverage, similar to what you would do with a residential property, and see a property investor, renovate a property, hope that it goes up in value, revalue it, strip some equity out, go again. Through this structure, obviously that's something that you can't do. It gets held in its own individual bear trust, and it just ticks along for the long term there.
That's it.
The only way you can get access to that cash is to sell that property down. And that may potentially form a strategy for some people that if they've seen some decent growth and they want to tap into that equity by selling that and making those funds liquid again and then splitting it up to a deposit on 2, 3 other properties. That's the only way that you can leverage within an SMSF.
Exactly.
So
yes,
a little bit different for the average property investor that's potentially listening and hasn't had exposure to SMSF before. Yeah, it is quite different in terms of how they will use it, and how you can grow it is much slower, more organic growth than that of a seasoned property investor that gets in there and does a nice reno and up-specs it and maybe adds a bedroom and a bathroom to it and can revalue it for an extra couple of hundred and strip some money out and go again. Yeah, your nest egg obviously grows a little bit slower because it's contributions, but the ability to sell it and then tap it into 2 purchases, 3 purchases is definitely a way that you can do that.
Yep. The limited recourse borrowing arrangement doesn't allow to pull equity out, which is, essentially what it is. So yes, we will build wealth slower. I've had 2 clients that have used SMSFs specifically for commercial property in 2 different ways recently. The first one was that they bought commercial property, getting close to retirement. They bought this commercial property 20 years ago. It's producing a nice rental income for themselves. However, it was nearly $100,000 worth of rental income. They're going to have to pay tax on that each and every year. Whereas inside a super fund, once your super fund's in retirement phase, the income tax goes to 0. So therefore, we work it out on a long-term scale. Yes, it's a taxable event to put it from your personal name into the self-managed super fund, but that capital gain and the tax that we have to pay initially is far outweighed by the benefits that they get, that they never have to do an income tax return ever again, and all the income derived now that they're in pension phase is all tax-free. So they get the tax benefits each and every year. Yes, it's one little lump sum this year. Yes, we can make some contributions into super as well to reduce that taxable income, especially if you're getting closer to retirement. So it can be quite a nice way if you've built wealth outside super, you've got the benefits of the income, but now you're getting closer to retirement phase. It's really key that you have a look at your after-tax perspective. So it's a great win for that client moving forward. Another one that I've had as well is a young couple had a commercial property in their own personal name. They've also got their family home. Because it was negatively geared, it was draining so much of their personal cash flow that it wasn't allowing them to go on to family holidays or live the life that they wanted to live. So by moving the commercial property that their business was renting, moving that into a self-managed super fund, there has to be some specific Superannuation Industry Supervision Act that you have to adhere to, which is called the sole purpose test. It means that the rent that the business pay has to be at market value. It can't be higher, it can't be lower. There's some specific rules around that to make sure that you meet the sole purpose test when you are borrowing from a related entity or renting from a related entity if your business is renting from your self-managed super fund. But in essence, all of their income was soaked up. They purchased this commercial property. They had all of this income sitting inside their self-managed super fund. Plus, they also had their contributions from their employer going into the super fund, a stack of income going in there, and it was just in some industry funds. We had transferred the commercial property into the self-managed super fund. It knocked out a whole heap of debt in their personal name. Plus, it freed up around $3,500 a month for them in their personal cash flow, which then significantly reduced how quick they could pay off their principal place of residence, start booking holidays. From a cash flow perspective, personally now, it really made sense. And then also, because we do build wealth a little bit slower inside a limited recourse borrowing arrangement with an SMSF, it ticks so many boxes for them. They could still retain their commercial property. They didn't have to sell it. It's actually allowed them to go and up their rental property in terms of they can develop it more. So they've got a 2-story building, but the upstairs building, they needed around $50,000 to go and put a fire system in and to go and upgrade it. They didn't have the money to do that, nor could they borrow any because they were tapped out and how much this was actually costing them. The super fund did have it. The super fund can borrow it. So now that they've turned their income that they were getting from that commercial property and they've literally nearly doubled the commercial value of that property because they could now do the work. They can get more rent, double the rent for the property. It's nearly double the valuation, all within a 12-month space. Plus, they can breathe a lot easier. A couple of ways where self-managed super funds can work really well. From a lending perspective, you mentioned that lenders see it as a different risk appetite. Is the rate the same as if you're just going to borrow in your personal name compared to a self-managed super fund?
So rate's a bit higher. So you'd be looking at the moment sort of anywhere between the mid sixes, depending on the asset and the applicant and the loan to valuation ratio, anywhere up to sort of the 8s to 9s. Now it is interesting. There are lenders that will still go up to potentially 90% of a loan to valuation ratio, which depending on what someone's objectives are, if you do have a deposit that can be split over a couple of properties, and their long-term look is that, you know, they can potentially get more leverage than what they're going to be paying in the rate is maybe splitting it over a couple of properties to start with, so that you do have that aspect of leverage without actually leveraging against the different property values, and then revaluing within, 2-3 years to then get that rate down to an 80% rate. So that's another way that you can potentially look at it. Something I thought was really interesting before was around the income through retirement phase was at 0. Capital gains, is it the same for that?
Capital gains is exactly the same as well. So if you hold that property until you're in retirement phase inside superannuation, which is generally after 60 and retired or age 65, if you then sell that commercial property, let's say that you bought it 20 years ago for $500,000, 20-year property's done, nice, it's doubled, plus a little bit more, and it's now worth $1.5 million. You've got $1 million worth of gain there. If it's inside a self-managed super fund and you're in a retirement phase, that $1 million worth of capital gain is all capital gains tax-free. So it's quite a big win. And in terms of if you've got $1 million worth of capital gain tax to pay, you obviously halve it, $500,000, but that's still quite a lot of money to fork out in tax, where that's 0. Nice way to build a long-term wealth if that's what you're looking to do. And we always talk through with clients with their retirement strategies, where's their income coming from? because a property might not be able to fund their entire retirement income that they need. If they need $2,000 per week and the rental income's only $1,000, well, where's the other $1,000 coming from? If that's the only asset that you've got inside a super fund, it might be at that time when you're retired that you sell it, because it's very hard to sell a bathroom or very hard to sell a garage if you want to go and take a European holiday and you need $50,000. Can't happen that way. So liquidity is important, especially when you're getting into retirement phase and you're looking to live off your retirement income. The liquidity piece is absolutely critical to work out how we're going to fund your retirement lifestyle.
And also couple in with risk at that point as well, because depending on age and liquidity requirements, if you have sold that property, you wouldn't necessarily want to have it in anything that's high risk. You'd probably look at a lot of sort of cash investments at that point in time. If they are through retirement, they do want to travel. At that point in time, the return on investment probably isn't as important as what it would be going through your 20s, 30s, 40s. When it's about accumulating wealth. At that point in time, it's about preserving wealth and a high amount of liquidity, I'd imagine, with a lot of the people that you're seeing
absolutely.
in that bracket.
It's something that I talk through, is that generally when you first retire, you're going to be at maximum wealth. Your wealth is not going to really start increasing because you are no longer working, so you don't have that income. And now you've got investable assets that you're going to start deriving an income from. So when you do retire, you're at maximum wealth that you're going to be, or pretty close to it. So managing that risk factor to make sure that we're not overexposed to the market, so that we don't see our $1 million, $2 million portfolio drop 20%. It's a pretty scary drop. If you've got $1 million now, you've got $800,000, especially if you're not working anymore. So yes, liquidity one, risk factor and how we invest that money is important through retirement. However, we are living longer and longer. Jared, when you get to 60, you've still got another 40 years to get until you get a letter from the king. So that's 40 years that we need that money to still be working for you, so you can continue to live off it. Because if we get too defensive and that money was just going to earn 3, 4, 5% in cash, it may not be enough to keep pace with inflation plus provide you with an income stream. So it's important when you are retired to make sure that you're looking across all aspects of how your retirement money should be invested. The thing that I want to talk to you around self-managed super funds is, what's the cost? How much does it cost to set up?
Well, that's where it's important to work out what your goals are, and if you are looking at buying, a property just for the sake of buying a property, is it the smartest decision? Because it isn't like having money in an industry fund. The cost of setting it up can be anywhere between $5,000 and $10,000. Annual audits as well, to make sure that you do remain compliant, that we're not creeping over into that non-compliant bracket that we don't want to be a part of. So the costs involved can be substantial to set it up. But ongoing, as long as it meets your requirements moving forward and you feel that there is more to be made by having it within there, those initial costs wash out over a 30, 40-year period on, factoring in just your annual audit costs. You're going to be looking at probably $2,000 to $3,000, depending on your accountant and how many other things that you've got going on with them at any given time.
Yes.
But most super balances to have a look at it, look for both lending requirements and from an advice perspective with SMSF, you'd need to have at least $200,000 to start with in terms of liquidity to make it worth your while. If you've got $100,000 in there, that cost is going to be eroded. That cost is going to erode into that balance very, very quickly in terms of a percentage of your holding. So be it for advice or be it for lending, you'd find around that 200, 250 is going to be a starting point to make it beneficial and have it within there.
Yeah, it is pretty much a starting point. The guide from ASIC used to be for financial advisors is that $200,000 was the minimum, because you do have those audit fees, ASIC fees and accounting fees each and every year. However, when you're looking at investments and your superannuation specifically, even if it is in an industry super fund, you don't have an accountant fee, but you'll have an investment fee that most people don't understand is a percentage already of your assets that are inside super. So say if your investment fee is at 0.5%, that's what your super fund charges you to hold it. They probably won't tell you that. They'll probably say, look at how little our account fees are. But there's an underlying investment fee for how they invest your money, because they do invest your money. So if it's $1 million and there's 0.5 of 0.5%, there's $5,000 worth of fees that you're paying. If you compare that against an accountant's fee, that's probably $3,000 to do it, and you've got a property in there. Well, fees from a perspective of looking at apples for apples are probably pretty similar. So it's something that you need to look at long term. Yes, there are fees to be paid, but you still already pay fees inside your superannuation, how it's invested now. So it's not that you pay no fees now and you start to pay some when you've got a self-managed super fund. It's not how it works. $200,000 is generally the minimum. If you're going to purchase a residential property, we like to see a little bit more than that, depending on the actual asset value that you're buying. The reason being is making sure that because the lending is high, you've got additional expenses, plus your accountant's fees and things like that. There's additional expenses in there. We want to make sure that from a cash flow perspective, that it stacks up. We've got higher rates of lending. We've got the admin fees. We want to make sure that the borrowing is probably around the 60% up to 70% for a residential property. You can go a little bit higher than that with commercial property, but to factor in and bake in a factor that we're happy and comfortable with, those are the sorts of levels that we need to see. I have set them up with lower than that where it made sense when the commercial building for a business owner was less, was around the $300,000 mark. So we've set them up with a little bit less than $200,000. We've also set them up with lots more than that where it really makes sense for clients. So it just depends how they are looking at the long term for themselves, what their superannuation balances are, how much super contributions are going in each year from their employer. It's 11.5% currently, goes to 12%. So if you're on 100 grand for the year, it goes to $12,000 each and every year. If you and your wife are on $100,000 each, well then there's $24,000 worth of income going in there that can service a property plus the rental income, which can be quite a nice way to leverage yourself and build wealth long term. Pros and cons, obviously, of setting it up can be complex because we talked a little bit around a limited recourse borrowing arrangement and a bare trust. You've got a self-managed super fund. Also, there's difference between the structure of a trustee, which we haven't spoken about. I don't want to bore people and go through structures, but a trustee, you can either have individual trustees, which is Jared, if you were to go and have a self-managed super fund, Jared's is the individual trustee for Jared's super fund, or you can have it as a corporate trustee. So it could be Jared Proprietary Limited as trustee for Jared's superannuation fund. This is definitely not personal advice. This is general advice only, as always. But a corporate trustee structure allows you the flexibility that you can go and add members into that trust deed really effectively and easily without changing who the trustee is, because you can just add them as a director of that company structure. If it's an individual trustee, you're going to need to rewrite the trust deed document to add that new member in there. So if you wanted to go and add a new partner or maybe a child at some stage into the self-managed super fund and you don't have a corporate trustee, you're the individual trustee, it's going to cost you basically the initial setup again for an accountant to write another SMSF trust deed and get that established for you. So making sure that you've got the right structures to start with. Corporate trustee is usually best practice. However, it comes with additional costs because you've got a company structure set up just for the trustee that does nothing other than be the trustee, but then you've got asset fees each year that you've got to pay for a company that does nothing other than be a trustee.
It's about getting it right at the start and working out what the objective is, isn't it?
Long-term planning, mate, as we like to talk about on this show, it's always looking long, playing short.
Absolutely.
What we need to be doing long-term, but also playing now so that we can make the right decisions now is going to really benefit us when we look to utilise these assets in the long term.
Absolutely. Now, the other thing to keep in mind is lending with it. Now, turn back the clock, nearly 10 years, majority of the majors and second tiers backed out of SMSF lending. We still have a lot of lending options, but they're usually in the sort of third tier and non-bank. And what I mean by that is it's not your big four banks that you usually would see. Good thing about that is that they have lots of specialist offerings, and they might have a really good niche within commercial SMSF or residential SMSF or a whole array of different ways they can set it up. But it then means that it's really important to make sure you're talking to the right people that truly understand SMSF lending, because there's two levels of complexity to it. There's the understanding the trust and the structure, which not every broker will do. And then there's also understanding the SMSF lending and the requirements and those lenders. So that's where the broker comes in there and makes sure that it is right for you in terms of the asset that you're buying. Quite often in terms of SMSF purchases, you have a look at mum and dad that go out and buy an investment property. Pre-approval is usually pretty key. With SMSF, because the assets are potentially different, a lot of the time you won't actually see pre-approvals done in those instances. You'll see brokers do really high level servicing, engaging a number of the different lenders they think it's part of, but they won't actually make that choice on who the best fit for that lender is until the point that you find the asset that's coupled with it, because of the fact that it could be very much better suited over here to lender X as opposed to lender Y. But making sure they've had those high level conversations with business managers within those businesses, and have got, you know, the tick of approval in terms of income, the fund, the structure is super important.
Absolutely. Structure's important, lender's important, but I think the team, more importantly, is important if you're going to look through a self-managed super fund. You will need a financial advisor to make sure it's going to be the right fit for you to do the long-term planning. You're going to need a broker if there's any lending available or not available that you need to facilitate a property purchase. You'll also need an accountant to establish the funds. You'll also need a solicitor to go through when you've got a property transaction. You'll also need, as well as a solicitor, you'll need independent legal advice to make sure that you understand what you're getting in. So there's potentially 5 different people that you need to engage when you're purchasing a property through a self-managed super fund. And if one of them doesn't talk to another one, you can really hold up the deal and you can have that fall over, especially if you've gone for a property and you've bought it. Or, you know, subject to finance, and if the account's not set up, if the broker's not ready, if you don't have that solicitor set up and liaising with the purchasing solicitors, or if you don't have the independent legal advice in time, it can really kill the deal. So making sure that you've got the right team around you is critically important when utilising a self-managed super fund to continue building wealth.
SMSF would be the definition of looking long and playing short, wouldn't it? So a high risk, high reward strategy for people looking to, really put a rocket into their investment strategy.
Yeah, absolutely. It's not just you're sitting around at the barbecue and, you know, Jared's talking to me around how great a self-managed super fund is. You really have to understand the obligations that you need. One is the trustee, the team that you need around you, and is it going to be beneficial for you long term? Hopefully that's a little bit of a guide into self-managed super funds and how it can be beneficial for this episode. And, you know, we obviously work with a lot of clients with self-managed super funds. But thank you again for listening to Your Wealth Playbook, and we look forward to coming back with some more information around building wealth, looking long, playing short.
We'll catch you on the next episode. Thanks for tuning in.